Hello, everyone, and welcome to another episode of the Property Trio podcast. We're talking market update today with my two lovely and handsome co-hosts, Cate Bakos and David Johnson. How are you both today?
Very well, thanks,
Great
Mike.
to see you.
We've had a little bit of a practice session with the Stig of the show, who's Jamie, our editor, and I think the Stig was good because of the mystery. I think we should build on the mystery of Jamie. He should feature more in the podcast. This mysterious man behind the scene.
I think it's a good idea.
Much overdue. I had my microphone around the wrong way. We had our dials wrong. He sorted us out. So I hope our listeners can pick the audio difference now.
Yeah, let us know on the iTunes review with a 5-star and your comments at your leisure. We'd love
podcast.
to hear from you.
Sound hasn't been that great at times, but it's much better now.
Yeah,
Although we did get a listener question where somebody said, love the show, particularly Cate, ... The dot was very sort of suggestive.
Oh, wow. I wonder what that was.
I don't know. That's coming up in a future episode.
What have I done wrong? Yeah.
Are you happy with the being on YouTube now?
I think they just like that I hold you guys accountable and try and keep the talk off sport.
Yeah, well, we're not talking sport today. We're talking roller coasters.
Oh, my God, roller coasters.
What did we do on the weekend?
I went to the Goldie and stayed with the lovely Ren from my team. She moved up there a while ago. And people don't know it because she's just so seamless and so on. We work remotely and we learned how to do that during COVID. So when she said she wanted to move and still wanted to keep working for me, I was like, well, you know, I'm going to miss you in the office, but let's do it. And we try and catch up. And she's got two beautiful little boys and they're 8 and 10. And so Gab and I went up for a fun weekend and you know, you get to Ren's place. There's always some nice champagne in the fridge and they've put in a new pool and spa and the weather was good. So we grabbed our bathers and we jumped in the spa and boys are splashing around in the pool. And a couple of many champagnes later, they're saying, can we go to Dreamworld tomorrow, Mum? Can we go to Dreamworld? Can we go to Dreamworld? Like that Homer Simpson and Bart thing where he's like, can we go to Splashdown Park? Can we go to Splashdown Park? And just keeps doing it till Homer breaks. And like, all right, fine, stop it. So I did 17 roller coaster rides on one of the worst hangovers I've had in a long time. It was horrible. It was a good weekend.
17? That's commitment.
Yeah. Well, it was not busy. We got there nice and early and it wasn't school holidays. So it was kind of just, you know, the locals wandering around and these kids were just so excited about a couple of the roller coasters. And one of them, you see it from the freeway and you think, oh, gosh, that's a bit hairy. It's called the Taipan. And the little guy, he was riding in the carriage with me. We tag teamed it with each of the boys. And we stood in this queue. It was the longest queue because everyone wants to have a crack at the Taipan. And when we got to the front after 35 minutes of waiting, he sort of needed to go to the toilet. I was a bit stressed about that. But I was more worried that bar that they put against their head, you know, it would have whizzed over his head and it would have broken his heart. And it's like just touching the top of his head and his hair's ruffled. And I said to him, come on, it's not going over his head. Like, Brandon in the queue, let's go. He's so excited. And he just goes straight for the very front carriage. This kid had nerves of steel. And it was one of the scariest rides I've done. I've tried Superman before and that was a little bit hairy, but I thought it was great. The Taipan, it was very, very scary. And as soon as it was over, he wanted to go back on it again.
Is a giant drop still at Dreamworld?
Yep.
Wipeout?
There's one that they took away.
Wave one and it go up top and then it spins around, you hang upside down and then come back down.
Yep.
I think the log one had to go.
Yeah, the log.
Yeah.
No, the log one.
I'm not talking about that.
Had trouble. Yep. Good old Dreamworld.
Anyway,
Understatement.
that was my fun weekend. It was great, but I was exhausted.
Can only imagine the hangover after drinking in a spa. I mean, spas dehydrate you at the best of times.
Just drinking water and eating Panadol all day. It was vile.
Oh, ouch.
But Riley thought I was cool. That's all that mattered.
That's paid your dues.
Dave, how are you going?
Really well, thanks, Mike. Well, my weekend consisted of a little bit of a basketball grand final. My eldest son's basketball team that I helped coach first year for all of them playing basketball, and they just continually improved across the season, snuck into fourth spot, won the semi-final by a point, knocking off top spot who were undefeated all year, and then managed to win the grand final by 4 points. So there were some very excited boys and parents.
Yeah,
and
that's
we
lovely.
all went to the Glenferrie Hotel afterwards for a few hours and enjoyed the afternoon. So that was a bit of excitement on my weekend.
Nice. Awesome.
Lovely.
Is that the one with the beer garden or is that the Auburn?
The Auburn has the outside beer garden. Oh, the Glenferrie does as well, right out the back. But it's
That's a
it's a big
destination
old,
when Mike's
beautiful
in town.
old. Yeah, beautiful old building. They both are, the Glenferrie and the Auburn.
Yeah.
So, but look, it was just, you really just love the improvement of the kids over the season was amazing. They just work so well together, support each other. Yeah, it was fantastic for them. It was great.
So good for kids.
That's lovely. All right, let's get into the content for today. We're talking a market update. We've got all of the figures hot off the press, some of which were released yesterday, talking about everything property. We'll start with the typical core logic monthly data. We've seen a 0.8% rise across the nation, with that being 1% for the capitals and only 0.1% for the combined regionals. And notably, the housing market has ticked over 10 trillion in value quite recently as well.
It's a real benchmark, isn't it?
Yeah. So I mean, across the
How many
board, we
noughts
saw
is that, guys.
yeah, more than I can count. Across the month, we
13?
saw every capital city up except for Hobart, which was only down 0.1%. So that's obviously helped to tip us over into that $10 trillion mark. What was the takeaway for you guys in terms of the monthly movement, or perhaps the quarter, which can be a bit more telling?
Well, the month was almost positive if it wasn't for Hobart, and Hobart is looking more healthy now than what it has been in recent months. Minus 0.1's not a terrible month. It just means that it's leveling out. So we've got a market that's completely in recovery by the looks of things. Sydney has slowed down, Melbourne has slowed down, but Brisbane has ramped up 1.5 in 1 month. That's significant, and it means that if you're buying $1 million house in Brisbane, its price point's moving $15,000 every month.
Yeah, that puts it into context.
That's the only way you can. When we're in a moving
it's
market, I have to say that to clients. You have to look at the data and go, do you know what? Every month that it takes, and it's a horrible thing to do, but it's better to tell someone at the start of their journey than 6 months in when they're still working off their old budget and looking at the same properties. When you put it into perspective, they start to look at things differently. I
remember hearing from yourself in Melbourne and Melinda Jennison in Brisbane that when the market was moving, post-COVID at the rapid pace that we saw, that's even faster than today, that people were waiting a month and then their brief didn't match anymore. They were having to now look into different suburbs. Like just in 30 days, it's like the suburb's gone now. Where are we looking from here? And, people are rightfully stunned.
At one stage, we were moving $1,700 a day on $1 million house. That's eye-watering.
Dave, when it comes to Hobart, we've seen a 10% drop in the annual dwelling values on record. Bottom of the market?
Look, it's a really good question. It's going to depend on stock levels. We'll get to listings, but we saw a bit of a jump in listings over the last couple of months compared to historically during winter. So that's probably a sign of people starting to be more comfortable selling or need to sell. So whether that's, Hobart has had huge numbers of listings relative to historical numbers, and that's played out in that 10% drop over the last 12 months. I'm not going to call the bottom for Hobart. But
this was a hatchet job, just to be fair.
It very well might be. But very good question without notice, Mike. But look, I mean, some of the takeaways for me were, if we look at the home value index, it's up 4.9% from the bottom. So Sydney is up 8.8% from when it bottomed out. So it's actually risen more than any other capital city. But keep in mind, it fell further than any other capital city. So house prices actually fell 15% in Sydney. Units not quite so much. Brisbane is now second, up from its lows at 6.2%, second highest. And on average, the capital cities have risen 6% from when they bottomed out, but the regions have only risen 1.6%. And when you say the regions, you can almost put an asterisk next to that, because the regions that have really driven that 1.6% are the Sunshine Coast, Gold Coast, and Coolangatta. And to put some perspective around that, the Gold Coast has a larger population than, and if you include Coolangatta, then Canberra, Hobart, and Darwin. And the Sunshine Coast has a larger population than Hobart and Darwin. So there is becoming this sort of increasing disparity. And we know it's playing catch up between the capital cities and the regions. And so that's certainly a story that is playing out, which we'd really talked about probably for a couple of years. And I know I'd made some predictions at the start of a year, probably 2 years ago, that would happen. So, it's finally happening about 18 months later. But that certainly is one of the pictures that is forming more clearly.
And Cate, you've often reported on sea change, tree change movements. So does this data, do you think, point to the fact that the exodus that we saw from the capital cities is at least reversing to some degree?
Yeah, to a degree. We've got stability in some regions, but certainly the smaller regions and the ones that are quite removed from employment centres, we've seen them come off. And anecdotally, I've had some of the agents say that as well. So, anybody that's been looking at holiday hotspot ideas, I've said to them, let's ride this wave for a little while longer and keep an eye on things, because I'm concerned that your timing is really upside down. And I know people that have pursued holiday houses in coastal areas.
Reminds me of play school. Remember Miss Upside Down, Miss Jane.
Yeah, Miss Jane Upside Down. Yeah, it's a tough one though. I think a regional city is very, very different to a coastal holiday hotspot, and that's what our listeners need to be prepared to question. Because if you're thinking that something coastal in a remote little township that's a long way away from a centre of work, if you're thinking that is the same regional ideal as a strong regional city, you're getting it wrong. And even comparing somewhere like Geelong and then something coastal a long way away, that Geelong would be your closest city. Well, Geelong has all of the things that anybody could need. It's got education, healthcare, it's integrated with, everything in the community, and it's well connected to Melbourne as well. You don't need Melbourne. You can do just fine with Geelong as a great city, but you can't compare Geelong to something random an hour away down on the coast.
No. That's an interesting insight, and contrasting that, adding to that data that Dave was sort of sharing about the population centres. When we talk about regions, I inherently think of, out in the sticks, like in New South Wales, that might be, sort of like Dubbo, which is maybe 3 or 4 hours drive from Sydney. I don't really think about places like the Gold Coast being a region or Wollongong being a region, but there you go, very different fundamentals, right?
Yes. Yeah.
And I think it's sort of, again, that devil's in the detail, isn't it? Where, some locations are counted in regions that have bigger populations than some of the capital cities. And, there's serious regional centres and cities, and then there's, tiny little country towns.
Yeah. Simon Presley does some amazing work on identifying strong regional performers. And I think he articulates it really, really well. But the point is, a city doesn't have to be a capital city to have everything that the population needs and really strong fundamental growth drivers. We just have to discern little teeny-weeny regional townships that you might holiday or have a farm on versus a regional city.
I I don't know if this is a metric that CoreLogic will ever adopt, but I've always kind of thought if the city has an Ethiopian restaurant, that's where you know it's kind of broken through to the point where it's got, robust fundamentals, right? Like if you can get to the point where there's an Ethiopian restaurant, you're going to have a diverse culture base, you're going to have a reasonable population. I just did a quick check of the 10 best Ethiopian restaurants near Geelong, and there is
they're all in Footscray, right?
There's probably some correlation too with the percentage of plastic surgeons per population head count as well, I'd say.
We should test that. Actually, it looks like there are no Ethiopians in, Ethiopian restaurants. There are probably Ethiopians. But yeah, they are all in Footscray. So there you go. In the West is really representing there, Cate. So you've won the Ethiopian contest. Let's, before this gets even more ridiculous, this always happens when I host.
I know.
Let's talk about
track.
I know. Let's talk about rents. Annual change in.
I just want to share one last point before we move on, just on property values. So you recall, our listeners, I'm sure, will recall the episode we did where we actually looked at the years interest rates rose and how there wasn't actually a correlation that property values fell. Yeah. And although property values fell by 0.5% in 2022. 2023 is currently at a minus 1.1% for the first 8 months. Now, the trajectory we're running at with 4 months to go, we're 0.8%. So for the last month, so that would average out to 3.2% of growth. Even if we allow for movements either way, we're looking at another 2 to 4% of annual growth over the last 4 months. That's going to leave this year in positive territory. Despite rates falling. So when historians look back and, they tend to look over the whole calendar year, we're going to have another year, 2023, where property values have grown despite rates falling. So I just thought it was timely. Did I say, yeah.
That's okay.
So I just wanted to make that point because I just think it's an important, because sometimes people really oversimplify things and say rates rising, property values falling is one of the most common ones. Yes. And that's not going to be the case for 2023, despite being on the end of the fastest rising set of interest rates in history.
Yeah, we've covered this off in a few last episodes, and it's a great point. And I think you've got so many other drivers that you need to pay attention to. You can't look at something in solitude. And so we've had, in addition to being the year that's had the fastest rate of interest rate rises, we've also had one of the fastest numbers of new arrivals.
Yep.
And we've had one of the most attractive unemployment rates. And those things in tandem have just done wonders.
And new construction, therefore new supply, has fallen off a cliff, really fallen away as well, is the fourth factor there.
Yeah, that's an interesting point because it seems intuitive that rates go up, property prices go down because we've got kind of less borrowing capacity and less appetite to invest perhaps. And by the same token, population increase means property prices go up in a location. And you mentioned Simon before, he has disproven that wholeheartedly, but it's all those things in tandem. And if we didn't have a bit of a construction cost or construction labour crisis, if we had high employment, then, it's quite possibly property prices wouldn't have done what they've done. But it's all those things in concert that make the difference, right?
100%.
Rents. Houses versus units, it's a very different story. I think units, I've probably banged on about this a fair bit. Units really got hammered during the pandemic. There was a huge amount of vacancies, and the net result now is that we've seen annual change in rents up 16.7% in Sydney and similar in Perth, and both Brisbane and Melbourne in and around 15%. So a crazy pace of change for those capitals in rents for units, but houses is not that far behind, with Perth looking at 13.3%, Melbourne 11.9%, and Sydney 8.8%. There's been a lot of talk about the Greens getting their way to encourage the government to spend an extra $1 billion on housing. So now we've got this $10 billion housing plan, which I think they're talking about, 33,000 social homes. They're talking about building something like 240,000 homes a year, which we've only ever done once before. And they're now saying that they're going to do that consecutively for 5 years. Begs the question, is that even possible?
Yeah.
But what are your insights for rent, Cate, and where do you see rents heading in the next little while?
Well, these charts are still pretty horrendous for most capital cities for both houses and units. Obviously, Canberra and Hobart rental prices have come off and they're in negative, at least for houses anyway. So you can anticipate you'd pay less for renting a house now in both of those cities than what you would have a year ago. But interestingly, everything's come off a little bit except Perth and Melbourne. So if we have a look at houses for Melbourne, that trajectory is not coming off. It's still pointing to the sky. Perth is looking like it's starting to level. Perth units are still going mad. So I think that we're going to see Melbourne and Perth continuing to break records here and be the strongest capital cities in terms of rental growth rates. And no surprises there, particularly with Melbourne. We've had all kinds of things working against us, but we've also seen a lot. We've broken the record for all of the states in terms of investors selling out.
Yeah.
Dave, I want to ask you about Perth specifically, and this is data that I'll share with the show soon, but we've done a preliminary crunch to see the percentage of property investors that are buying into WA based on our data compared to other states, and traditionally it's always kind of sat around 7%, and we'll be reporting it in and around a quarter of all property investments are happening in the state of WA compared to other states around the country, which is the biggest I've ever seen by a long margin. And I see so much money from the East Coast going over to investment in Perth. And Cate's shared some graphs about migration into Perth as well. But how are rents still going so strong in Perth with that amount of investment? Do you think the writing's on the wall for a drop, or is it there's just so much demand with the extra migration?
Look, I think, the tide's been out for a long time with Perth, and then that was compounded during COVID because we literally couldn't cross the line to get into their state. And I think, that, and with mining recovery and then the transition to clean green energy and critical minerals, I think there's a real positive sense and sentiment towards Perth and WA, and that's playing out. Perth's had the strongest capital growth over the last 12 months, and its rents are really flying as well. So I think this has probably been a long time coming, and those numbers that you've just shared, Mike, are really interesting. And I'd say, therefore, that's still happening because your numbers are obviously quite recent. So I think this still has a while to play out. Would be my sense. So, and I think Melbourne has underperformed in terms of the capital growth relative to the other capital cities, probably for 2 to 3 years. And given the rents are staying stronger for longer, I think that'll end up flowing through to the capital growth for Melbourne as well, would be my take on some of that data.
Now, to double up on Dave's points about WA, I'm just jumping the gun here and fast forwarding to the wages price index. And I downloaded this off the ABS and saw some interesting charts. WA is through the roof. It's the market leader out of all of our states for wages growth. And that has a direct correlation as well. If people can afford it, they will pay it.
Yeah, and I think a lot of people are starting to try to put money and chase the next boom as we transition from fossil fuel mining to, as I said, clean green energy, and I think a lot of that will come out of WA again. So, and that wage growth is really supporting that, doesn't it, Cate? That was a really good pick-up by you.
Oh, it was quite a stunning differential.
And from a median price point, Perth is more
Very
than
attractive.
$200,000 cheaper than Brisbane,
Yeah.
nearly $250,000 cheaper than Brisbane. So yeah, there's a lot pointing to value there. It's just a question of, Dave, you mentioned the tide went out. It did nothing for a long, long time. Obviously, it's a hotspot, and it's going to be, it's going to be talked about for a while as one of the biggest hotspots for 2023. But it just begs the question, well, what's the next 10 years going to look like? And people get very, very attracted to timing these markets. And yes, maybe you could do 20% in 12 months, but then if you do 1% for the next 10 years, it might be better to get rich slow, as they say, but time will tell. I want to talk about
one other point.
Yeah,
Sorry,
Dave.
just one other point. Like macro level on rents, is it was the smallest rise in rents across the country of just 0.5% since November 2020. So that's 2.5 years. So there's a clear trend that rents are finally slowing down. Plateauing, yeah. So there's Melbourne and Perth, as Cate mentioned, they are definitely the outliers, but every other sort of city and location is falling, and that was the slowest growth in rent. So, that's a positive sign, I guess, for any renters out there. And it also, I guess, hopefully minimises the chances for government to intervene and just create more problems, systemic problems.
Now, that's a correlation I wouldn't have drawn because they're stupid and they don't pay attention to data lag. So I suspect they'll oversteer first, Dave.
I had a button for that one.
Someone grab that steering wheel.
Politicians have wrong opinions.
There we go.
I love it.
I think that's pretty universal. Yeah, so if you look at the little graph trend from August 2013 to August today, everywhere from, say, 2000, we saw the rental vacancy rate, both combined capitals and regionals, dropping. And now it's found some sort of a floor, and it may be coming up a little bit.
Can't get much lower, that's all, Mike.
I know.
1%.
Like at 1.1
every
and
city
1.4%.
fell. Their vacancy rate fell or stayed the same again over the month. So we're just not building enough new properties.
We're so well below the 10-year averages. They've got this line for both combined regions and combined capitals. For the capitals, we're usually around 2.8%. And we're at 1.1. And regions are no different, from 3.2 to 1.4. I think we'll be stuck in that low vacancy rate environment for a long time. We need more investor participation for that to change.
Investor participation? I'm not hearing that in the political.
Well, no one's enticing investors
in the political
to come
discourse.
Yeah.
I think the problem is
just what 80% of
politicians have wrong opinions.
Anyway.
So every capital city had a reduction in rental supply, total rental listings in the last month.
Yeah.
Yeah, absolutely crazy. Vacancy rates national 1.2%. It continues to be crisis levels accommodation.
Have a look at rental yields though. How good's that? They've all gone up.
Yeah. I mean, great for investors. It's not a great environment for renters, and topping the charts outside of Darwin, which I don't know a lot of people that look to Darwin as an investment place just because of the volatility with LNG projects and that sort of stuff. Perth is leading the charge at 4.9%, and even Sydney at 3.1, Melbourne at 3.5. Those are pretty good yields for those locations that are typically closer to 2% or maybe high twos.
But also what just signifies it's just been playing catch up is the macro rental yield across the country is 3.82%. And historically, it's for the last decade average, it's been 3.89%. So it's only sitting around historical decade averages now after all this rent rises. Yeah.
That's an interesting insight. Let's get to some more positive news. And we've been talking about this for a long time. The spring selling season listings, we're talking about 5-year averages, and we've suddenly now got a lovely little graph saying that new listings are now slightly higher than the historic 5-year average.
Yeah.
So, Cate, you are pretty close to the coal face. We might need to update that term. Like mum and dad
the
investors,
hydrogen face.
We've got to update that. Yeah, we've got to look at the hydrogen
lithium face.
what's happening? What's happening on the ground?
Yeah, we've been smashed with some new stock, which has been great, but it's being soaked up really, really quickly. And if you look at the next chart, which is all listings, you can see it's still well under the 5-year average. So as quick as they can supply them, the buyers are grabbing them. I thought we might have seen some price falls when the spring market listings hit, but so far it's not showing any sign of market falls, and dare I say it might not, because buyers have a lot of confidence now that we've had 2 consecutive months of no interest rate movement, and they're getting their heads around everything and recalibrating their wish list. So I don't envisage that we'll get the price falls that some buyers have been hoping for, although if we get a really late spring flood of listings, which we sometimes do, vendors want to avoid the school holidays and grand final season and blah, blah, blah. They get their auction scheduled for late October and November. If we have enough of them hit, buyers might be spoilt for choice enough, and the buyer pool might be diluted per property, that they could see some advantageous purchasing. I'm not ready to call it yet though, because I've had enormous inquiry and buyers are definitely back with confidence.
David, just goes to show how thirsty the market was for stock. You know, we saw that jump, and as Kate's saying, it's just been taken up so quickly.
Yeah. Put a second straw in the drink, and it's being sucked as well.
Probably one of our worst metaphors yet.
That's a new one.
Yeah. But yeah, so what's your expectation of the market heading into that sort of peak selling season? Obviously, there's a lot of people that set, Christmas as that deadline, or, in and around the end of school. Do you think we will get to the point where there are opportunities for buyers, or is there just such a shortage of stock and so many people that are looking, and pent up demand for people that are maybe looking to upgrade but want to feel confident that there's choice, that where it's going to remain pretty tight?
Look, if I was a betting person, I would say that this is a early sign and a harbinger that we're going to have higher listing numbers for spring. And I just think, there is some pain out there. Anecdotally, there's some investors selling, there's so I think we could have some really strong supply, but it's making up from, a significant undersupply. We've seen so far for the 2 months or last 2 months of winter, some big rises in new listings of 16%, but that's all been absorbed. So, there's been buyers out there to take that up. But I do think that's probably likely to continue. And we might start to get back to, standard level, long-term levels of listings. So it could provide opportunity. But yeah, we've had now 3 rate pauses and possibly more. So there's also going to be that bell will be rung for many people to step back into the market as well and start to buy. So that's going to certainly offset that, along with obviously high migration that's occurring as well.
Yeah, and the headline inflation numbers are going to lead to a little bit more confidence, I would think. Now, as the host, I've done a terrible job so far and gone way over
just
time.
Chatterbox, don't feel bad.
Yeah, I know.
You've been putting your hands up. We've just apologized.
There's so much to talk about.
Driven through your hands with the Mack truck. Don't worry about it.
We probably went on about our weekends for a bit too long.
Oh, stop it. I had a great time.
But it'd be remiss of me not to bring the attention to consumer sentiment. We saw.
Would be remiss of you.
Yeah.
No, it's a really good
Family finances versus a year ago down 4.4% for the month. That's a huge change for September, and only down 10% for the year. So we've seen a huge sort of tightening of the family finances. And chronologically, I always get confused with this show, but we're going to talk about the mortgage cliff, or have we already talked about it?
Well, I think
we did an episode.
We haven't yet. We haven't talked about it.
That's coming behind the curtain, Dave.
But I think that's the answer, and it's not necessarily whether the mortgage cliff is affecting you. It's whether all the talk about the mortgage cliff is getting to you, because it's in every second paper.
Yes, I think there's something at play there. Not necessarily the mortgage cliff itself, although I don't want to give away the conclusion of that podcast. But that was a real sort of standout for me. Also, there's some pretty dire results on economic conditions over the next 5 years. time to buy a major household item. That's your toys metric.
Yeah. Well, it
Cate?
means that it's biting. Finally, our interest rate increases and pressures on housing and just domestic costs is biting. So we've seen a slowdown, and it's been pretty consistent.
Look, yeah.
So we were.
Overall, the consumer sentiment was pretty steady to August, wasn't it? We had a slight dip of barely 2 points, but still very low, historical lows.
Yeah. The big thing for me, Dave, is the gap between the time to buy a dwelling index, which on average is 121.3, but it's at 72.5, and the house price expectations index is 125.8 on average, but up to 154.6. So it's kind
Massive,
of like,
isn't it?
It's not the right time to buy a dwelling for our household, but gosh, dwelling values are going to go up. Is that the best read on it?
Exactly what
it's
what
the
it
read,
means.
which
and so people are waiting. They're timing it. They're thinking, it'll go nuts next year. We'll buy next year.
Yeah, prices are going to come down, but I just don't think they're going to come down at the moment. In fact, I think they're rising really, really rapidly. But it's not the time to buy. It's sort of illogical,
now is the
really.
time to buy. I mean, I don't want to. Yeah, this is not financial advice, and disclaimer. But I wouldn't be waiting to see all of these green shoots that people are waiting on. I think people are doing it tough, but if you're in a position to buy, I wouldn't be waiting any longer, honestly, because you're investing over a long time frame and trying to get that, to wait for that little extra 2%.
Social proof is so valuable for so many people, though. It's like when I can purchase a property for someone and there's no contenders. We want to buy it prior to auction and send out the agent. And, then they say, no one else wanted it. Should have I bought it? Did I pay too much? Well, no, you just got really lucky. We've done all the analysis. You bought a great property. No one contested you. Did you want someone to contest you? Because then we have a boardroom auction and you pay more.
I'd encourage our listeners who'd like to think more about this concept, go back and listen to our episode, Time in the Market versus Timing the Market, which we did in the first 20 or 30 episodes. And we really sort of unpacked this in great detail. And the odds of getting it right if you're trying to time it for when the market is falling is a very narrow window.
Yeah. We can't even pick it, and we're at the coalface and we're experts in our field. We might identify it and think, over the last 2 weeks something's changed, maybe this is it. That's about as good as it gets as a litmus test for us.
I've spoken to pretty much everybody in property in Australia, honestly, through podcasts and catching up with people. I've never met anyone that says I can time markets.
I've seen a few jokers suggest they can. I hope you haven't interviewed them.
No, probably not. Probably deleted them. A quick point on your pet topic, Dave, loans. A takeaway for me was that the percentage of lending going through to investment has been pushed to 35.6%, which is kind of good news for perhaps investor participation. But, investor loans are still down 7.2% for the year. What are the takeaways for you in the mortgage space?
Yeah, look, the number of people borrowing to purchase property continues to fall in the last couple of months. So that's a sign there isn't quite as much underlying demand. In terms of we might get to the refinancing table, but we had hit a new record high of refinancing again. So that's sort of driven off the fixed rate loan expiring mortgage cliff, and people are refinancing out of those onto a lower rate. The cash rebates ending as well. So refinances, hit a record high once more. Construction continues to, month on month change minus 21%. We just aren't building new dwellings, and that's a significant story and why prices are continuing to rise. And look, I think Cate provided some really interesting information, which I'd heard as well, about the fact that in terms of the personal loans, people have jumped up in terms of how much they're borrowing to go on a holiday.
Right.
So that's a bit of a concern. that shows how, I guess, people are feeling the pinch out there and they're borrowing unsecured loans to fund a holiday, which we certainly would discourage, because you're going to pay the price for that holiday over the longer term. And it's not a habit you want to get into, which means you're probably spending more than you're earning. Now, there's still, if you look at the graph, they're just getting back to probably historical levels, because we didn't borrow during those types of loans during COVID periods, because we couldn't go on holiday, so it really fell away. But still, it's a bit of a concern, that number.
Yeah, I've never borrowed. I don't think I've ever borrowed money to go on holidays. And, that's not because I'm some independently wealthy person. It's just kind of like, it just doesn't fit with my financial ethos, I think.
Yeah.
Yeah, it's all about good debt and bad debt, isn't it, Mike?
Yeah.
And
but you're right,
less
Dave.
than you earn.
Yeah. Pete Wargent said to me once, spend less than you earn, invest the difference. I mean, it's very simple advice, right? But that's all what investing's all about. Yeah. But you're right, Dave, that it's just sort of tracked back to the historical average of lending for traveling. But when you look at the graph, it's a ski jump, right?
Yes.
And I think when we think about the beginning of COVID, and this data is probably correlating with the back end of lockdowns, the household savings rate went through the roof. So people were probably quite confident to take the holidays, and every man and his dog went to Bali for a point in time. But I would expect that to really moderate in the next little while, right?
Yeah.
I hope so, because that's been part of, the discretionary spending that's got us into this trouble with inflation.
All right, I'm going to hand it over to you guys. We can talk about bond yields. We can talk about unemployment. I mean, that's pretty easy. That's kind of done. But we're way over time. But I think for me, wage price index and quarterly movements, which have just come out from Q1 for the ABS. I mean, there's some interesting stuff there. What do you guys want to choose your own adventure on?
Yeah, why don't we pick something each, Dave?
Boy, they were great books.
Yeah.
I just had my boys read one of my old ones.
I always sort of perished and then raced back to go, no, I meant the other one.
Yeah, exactly. And then you'd read it so much you knew which page it was turning to.
Yeah.
Then it was done. Look, I think, we certainly see a little bit of a tip on the way coming back down for the national wage growth, don't we? Just in the last so it sort of got up to about 3.5, 3.6 looking at the graph, and has just started to fall. That surprises me. I thought they would have further to play out. And I wonder if that's just a blip and wage prices growth will continue to increase. So that was one standout, but I won't steal Cate's thunder because she provided the movement for the states and territories. And
I noted the same as you, Dave. I thought that it would play out a little bit further, and the one that I thought was very relevant to the WA question we've already chatted about.
Yeah.
Something that I did note that Mike skipped past, and I totally understand why, Mike, was about business investment in purchase of property, and we've seen those figures drop consistently each month, and July was the most recent month that just came about in the ABS data, and again it shows that investment is down significantly. So businesses are pulling the reins in a little bit in relation to purchasing real estate.
Yeah, and I think that's not surprising with what's happening in the commercial market.
Absolutely.
Yeah, there's still probably more price falls to come in offices, and people are trying to hold for as long as they can without selling if the valuation is going to, particularly within real estate investment trusts, because it could cause a significant reevaluation of their whole portfolio if they sell one property at too lower levels. So it has a real flow-on effect.
Yeah.
All right, guys. Well, to bring this all to a close and perhaps even give you one last opportunity to pull some data that we didn't discuss already into the end of the show, we'll go to our gold nuggets section. Now, this is the point where people on YouTube, and of course, if you haven't checked us out on YouTube, go and do that. All of these are now live on video, and you'll be able to see that in this section of the show, whoever's the host will generally look at the faces and go, who looks the most prepared for their gold nugget? And I think Cate was looking away and Dave was staring at me. So I'm going to go straight to Dave because he seems ready with his powder dry.
Yeah, so that's unusual. It's normally Cate who's ready.
Now it's time for us to go mining for our gold nugget property tip of the day.
So, look, my gold nugget is that, we touched a bit on timing versus time in the market. And I think, it's wonderful to be across all the data and stats and information. But at the end of the day, if you're making a long-term property decision, you want to be looking at the fundamentals that have historically been the case rather than short-term changes, because, short-term changes are exactly that. And, if you're making a long-term decision, base it on really historically what's outperformed for the longer period in the location or areas you are looking at, or to choose your location where you're going to buy based on your price point and strategy.
Well, we're looking at the amount of stock and buyer sentiment, and people will be asking themselves, should I be purchasing first and then selling my property, or should I be selling first and purchasing a property? This is for all of the upgraders and downsizers out there, and I get this question all the time. Well, right now I feel that we're in a position where you could do either and have a long settlement on whichever one you decide to do first, and you're in a better position than what you would have been in previous months, because we've got strong consumer sentiment, buyers are back. We've got really amazing levels of listings at the moment, and I foresee that spring will be really good for that. I don't know what next year will be like. Our second busiest time of the year following spring is autumn. So you might get lucky in autumn, but autumn is never usually as busy as spring. So if you're in a position to purchase first and then sell second, that might work really well for you, but you've also got to ask yourself about the scarcity of the property you're either purchasing or selling, because if you're going for something super scarce to purchase, maybe knock that task over first. But if you've got a really tough house to sell because it's scarce, it might be scarce exciting, or it could just be something that's very unusual and needs to find its buyer, you should be chatting to a selling agent in your area who's great at what they do, and they can give you some guidance on how long it could take you to confidently sell your property at the price you want.
But I guess there's a bit more balance. So there's confidence on both types of decisions, whereas in the past it was kind of like, look, there's nothing out there. You need to buy something, right?
Yep.
Beautiful. All right. Well, let's call that an episode. Thank you very much to the both of you for joining me today on our market update, and I look forward to chatting to you both again shortly.
I'll see you guys soon. Bye-bye.
Cheers.